silver price. Prediction: will the plunge continue in 2026? Silver just broke a pattern that historically has only broken twice before in the last 50 years. Somewhere between the boardrooms of central banks and the trading floors of Wall Street, a decision is being made right now, one that could determine whether silver falls into a prolonged winter, or whether this is the final shakeout before the next major surge. The signals are already there, hidden inside interest rate policy, inside inflation numbers that don't add up, inside a geopolitical storm that refuses to settle. And by the end of this report, you will understand exactly what is coming next, before the majority of the market even sees it. Now, before we go any further, if you are one of those seasoned viewers who has lived through enough market cycles to know that patience beats panic every single time, do us a small favor. Hit that subscribe button, not for us, but for yourself, so the next time we uncover a signal like this one, it finds you first, not last. And while you're at it, tell us in the comments, which city, which country are you watching this from today? We would genuinely love to know who's tuning in from around the world. Now, let's get into it. Silver has always been a strange metal to understand. It is not just a safe haven like gold, it is also an industrial metal, used in solar panels, electronics, and countless factories around the world. This dual identity makes silver behave differently from gold during times of crisis, and that difference is exactly what analysts are watching right now. In recent weeks, silver prices have pulled back sharply. On the surface, this looks like ordinary market volatility. But when analysts look closer, they see something else. They see a pattern that has repeated itself several times over the past 50 years, and each time it carried a different meaning depending on the circumstances around it. To understand what is happening now, one must first understand why silver moves the way it does. Unlike gold, which investors buy mainly as protection against inflation and currency debasement, silver serves two masters at once. It is bought by investors seeking safety, but it is also bought by manufacturers who need it for real-world production. When global tensions rise, both of these forces can pull in opposite directions, creating confusion in the price. Right now, the world is dealing with exactly this kind of confusion. Tensions in the Middle East have created what analysts call a risk-off environment. In simple terms, this means investors are pulling their money out of assets they consider risky or less liquid, and moving it into cash or short-term safe instruments. Silver, despite being considered a safe haven by many, is often one of the first assets to be sold during these moments. Investors treat it almost like an insurance policy. When they need cash quickly, they cash in that insurance, even if they still believe in its long-term value. This is not a new phenomenon. History shows that during periods of acute stress, silver and gold can fall together with other risk assets, not because their fundamentals have changed, but because investors need liquidity immediately. Once the crisis passes and markets stabilize, these same investors often return to precious metals with renewed confidence, sometimes push prices even higher than before. But there is another layer to this story that cannot be ignored. Central banks around the world, particularly in the United States, have been sending mixed signals about interest rates. Some officials suggest rates may need to rise to control inflation. Others argue that raising rates further could put unbearable pressure on government debt levels that are already historically high. This uncertainty creates hesitation in the market, and hesitation often leads to selling, especially in assets like silver that do not pay any interest or dividend. At the same time, there is a growing gap between what official inflation numbers report and what people are actually experiencing in their daily lives. Many households and business owners feel like prices are rising much faster than the 2 to 3% that government agencies report. This gap matters because it directly affects how people value hard assets like silver. If real inflation is truly higher than reported, then silver's role as a hedge becomes even more important, even while its price is falling in the short term. So the question becomes clear. Is this recent plunge in silver prices simply a temporary reaction to global tension and interest rate uncertainty? Or is it the beginning of something larger, a signal that the entire precious metals market is entering a new and more difficult phase? This is not a question that can be answered with emotion or guesswork. It requires a careful, structured look at the forces driving this market, separating short-term noise from long-term signals. Business leaders, investors, and everyday savers all have a stake in getting this answer right, because silver's next move could carry consequences far beyond the metal itself. In the sections that follow, this report will break down the macroeconomic forces at play, examine historical patterns that offer valuable clues, and provide a clear framework for understanding what comes next. The goal is not to create fear, and it is not to create false hope either. The goal is to give a clear, honest picture of where silver truly stands today, and what serious decision makers should be watching in the months ahead. Because in markets like this one, those who understand the pattern early are always the ones best prepared for what comes next. Every market move has a story behind it, and silver's recent decline is no different. To truly understand what is happening, one must look past the headlines and study the actual mechanics driving the price lower. This is where the real story begins. The first force at work is interest rate expectations. When investors believe interest rates will rise, they often move money away from assets like silver that pay no interest at all. Holding silver means giving up the return one could earn from bonds or savings accounts. So even a small shift in expectations about future rate hikes can trigger significant selling pressure, regardless of what silver's long-term value might be. This is exactly what has been happening. Rhetoric from central bank officials in the United States has hinted at the possibility of tighter monetary policy. Whether or not those hikes actually happen, the mere suggestion is enough to shake confidence in precious metals in the short term. Traders react to expectations, not just outcomes, and this reaction has clearly weighed on silver. The second force is the strength of the US dollar. Silver, like most commodities, is priced in dollars around the world. When the dollar strengthens against other currencies, silver becomes more expensive for buyers using other currencies, which naturally reduces demand. A stronger dollar also often reflects a flight to safety, where global capital rushes toward U.S. assets during uncertain times, pulling money away from metals in the process. Then there's the matter of liquidity. During periods of geopolitical stress, such as the ongoing tension in the Middle East, investors and institutions often need cash quickly. Silver, being a highly liquid asset, becomes an easy target for quick sales. This is sometimes described as insurance liquidation. Investors hold silver as a form of protection, but when they need actual cash in a hurry, they cash in that protection first, even if their long-term belief in the metal remains unchanged. This is not a rejection of silver's value. It is simply a reflection of how markets behave under short-term pressure. However, there is a deeper layer that separates temporary noise from real structural change, and that layer is inflation. Official inflation figures published by government agencies often show numbers in the range of 2 to 3%. Yet many households, small business owners, and everyday consumers report a very different reality, one where prices for essentials feel far higher than official statistics suggest. This gap between reported inflation and lived experience matters enormously for silver's long-term story, even while its price struggles in the short term. If real inflation truly is running higher than official numbers indicate, then interest rates, even at their current levels, may actually be negative in real terms once inflation is accounted for. Negative real interest rates have historically been one of the strongest supports for precious metals prices because they reduce the opportunity cost of holding non-yielding assets like silver. In other words, the very conditions that seem to be pressuring silver today may be quietly building the foundation for its next major move upward. There is also the industrial side of the equation, which is often overlooked in the middle of a price decline. Silver remains essential to modern manufacturing, particularly in solar panel production, electronics, and emerging green energy technologies. A temporary slowdown in global manufacturing activity, driven by geopolitical uncertainty, can suppress industrial demand for silver in the short term. But this slowdown does not erase the metal's long-term role in the global economy. If anything, disruptions in supply chains and mining production during periods of low prices often set the stage for tighter supply once demand returns. This is the true anatomy of the plunge. It is not one single cause, but a combination of interest rate speculation, dollar strength, emergency liquidity needs, and a temporary dip in industrial activity, all layered on top of a much larger and more complicated inflation story. None of these forces, taken individually, tells the whole picture, but together they help explain why silver has fallen even while its underlying fundamentals remain a subject of serious debate among economists and investors. The question that remains is whether these pressures are truly temporary, or whether they represent the early stages of a longer and more painful correction. To answer that question with any real confidence, one must turn to history, because markets rarely move in ways that are entirely new. They tend to repeat patterns, and those patterns often reveal exactly what comes next. Markets rarely invent new behavior. They repeat old patterns, dressed in new circumstances. To understand where silver may be heading, it helps to look back at how the metal has behaved during previous periods of sharp decline, and what those episodes eventually led to. One of the most instructive examples comes from the period following silver's peak in 2011, when prices soared to nearly $50 an ounce before collapsing dramatically over the following years. At the time, many investors believed the metal had entered a permanent decline. Mining companies pulled back on exploration, capital dried up, and confidence in the sector reached historic lows. Yet what followed was not permanent destruction, but a long period of consolidation. Prices moved sideways for years, testing the patience of even the most committed investors, before eventually finding renewed strength as monetary conditions shifted once again. A similar story played out in early 2020, when silver, along with nearly every other asset class, crashed suddenly as the world reacted to a global health crisis. Investors sold everything they could to raise cash, including precious metals that many considered safe havens. Within months, however, silver staged one of its sharpest recoveries in modern history, driven by massive monetary stimulus and a renewed search for protection against currency devaluation. Those who understood the difference between panic selling and genuine fundamental weakness were the ones best positioned when the recovery arrived. These historical episodes share a common thread. In both cases, the initial decline was driven by urgent, short-term liquidity needs rather than a genuine collapse in silver's long-term value. Investors were not abandoning silver because they no longer believed in it. They were selling because they needed cash immediately, and silver, being highly liquid, was an easy asset to convert. Once that emergency passed, capital returned, often with greater force than before. There is also an important lesson from the mining and royalty sector during these downturns. When prices fall sharply, mining companies naturally become more cautious. They delay new projects, cut exploration budgets, and focus on protecting their balance sheets rather than expanding production. This behavior, repeated across the industry, eventually leads to tighter supply. Fewer new mines are built and existing operations become more conservative. When demand eventually returns, whether from investors or industrial buyers, this reduced supply can accelerate price recovery far more quickly than most people expect. This pattern connects directly to what analysts call the debasement trade. Over the past several decades, monetary systems around the world have consistently expanded the supply of currency, particularly during periods of crisis. Each time a crisis emerges, governments and central banks respond with more spending and more monetary accommodation. This has been true for over 50 years, and it has served as a long-term structural force pushing precious metals higher, even through periods of significant short-term volatility. Silver's plunge today does not exist in isolation. It exists within this much longer story of currency expansion and debt accumulation, a story that has not changed direction despite the recent price weakness. Of course, history does not guarantee that the same pattern will repeat exactly as before. Every cycle has its own unique triggers, and today's geopolitical tensions carry their own set of uncertainties that did not exist in 2011 or 2020. It would be a mistake to assume that simply because silver recovered in the past, it must recover again in exactly the same way this time. What history does offer, however, is a framework for asking the right questions. Is the current decline being driven by genuine changes in silver's long-term fundamentals, or is it being driven by short-term liquidity pressure during a period of geopolitical stress? Are mining companies responding to lower prices in the same cautious way they have in the past? And is the broader debasement trend, the steady expansion of currency and debt, still intact? These are the questions that separate careful analysis from simple speculation. And they lead directly into the final and most practical part of this report, where the focus shifts from understanding the past to preparing for what lies ahead. After examining the forces behind silver's recent decline and studying the historical patterns that came before it, the final and most important task is turning analysis into practical understanding. For business leaders, entrepreneurs, and serious investors, the real value of this report lies not in predicting an exact price, but in knowing what signals to watch and how to interpret them as events unfold. The first indicator worth monitoring closely is the direction of central bank policy, particularly from the Federal Reserve. Any confirmed shift toward higher interest rates would likely continue to pressure silver in the short term, since the metal offers no yield of its own. However, given the scale of government debt levels discussed earlier, many analysts believe there is limited room for rates to rise significantly without creating serious strain elsewhere in the financial system. Watching whether rate rhetoric turns into actual policy or remains mostly talk will offer an important early clue about silver's next major move. The second indicator is central bank buying activity. In recent years, central banks around the world have been accumulating gold at a historic pace, and silver has increasingly benefited from similar institutional interest. Continued buying from these large, long-term players would suggest that the current price weakness is being viewed as an opportunity rather than a warning sign. A slowdown in this buying, on the other hand, could indicate that even the most sophisticated market participants are becoming more cautious. The third indicator involves industrial demand data, particularly from sectors like solar energy and electronics manufacturing. Since silver is not purely a monetary metal, its price is also shaped by real-world usage. Reports showing steady or rising industrial demand would support the case that current weakness is temporary. A sustained slowdown in manufacturing activity globally, however, would suggest a more prolonged period of pressure on silver prices. Finally, geopolitical developments remain central to this entire story. Any meaningful de-escalation in the Middle East could quickly shift market sentiment, encouraging investors to move away from cash and back into assets like silver. Continued or expanding conflict, on the other hand, could extend the current period of uncertainty and keep prices under pressure for longer than many expect. For businesses and decision makers with exposure to commodities or inflation-sensitive assets, this period calls for careful, measured thinking rather than emotional reaction. Two broad scenarios deserve serious attention. In the first scenario, silver's decline continues or deepens, driven by tighter monetary policy and prolonged geopolitical stress. This would likely coincide with broader economic caution, reduced industrial activity, and a general pullback in risk-taking across markets. In the second scenario, current weakness proves temporary, and a combination of central bank accommodation, persistent inflation, and eventual geopolitical stabilization drives silver toward new highs, echoing patterns seen after previous major corrections. Neither scenario should be treated as guaranteed. The purpose of this analysis is not to predict the future with certainty, but to equip serious decision makers with a clear framework for interpreting events as they unfold. Markets rarely move in straight lines, and silver's history shows that periods of sharp decline have often been followed by extended recoveries, though the timing and scale of those recoveries can vary significantly. What remains clear is that silver's story is far from finished. The forces shaping its price today, from monetary policy to industrial demand to global currency debasement, are the same forces that have shaped precious metals markets for decades. Those who study these forces carefully, rather than reacting to short-term price movements alone, will be best positioned to understand whatever comes next.